Welcome back to Rockstock Channel. It is Tuesday, February 6th, New York time, late in the evening, early morning Wednesday in Brisbane, where we have, for the first time, Sam Catalano at Wilson's Advisory. This is a follow-up. We had Trent Barnett from Uras Hartley's, who put out a note that, lithium prices are too low. Sam at Wilson's has put out a similar note about incentive pricing, arguing that lithium prices are too low. We're going to get into that in a minute, along with, who is Sam and what is Wilson Advisory. And Rodney and I will have some questions for him. And he has a note covering broadly the sector, but he also covers 5 stocks, which we're going to talk to him about, including Atlantic Lithium, Leo Lithium, Ioneer, Core Lithium, and Liontown. And he has opinions on all of those. And we'll get into that in a minute. But before we do that, just want to remind all our listeners, if you like this channel and this content, please like and subscribe to Rockstock Channel. Hit the notification bell so you never miss a video. And for our Lithium Bull newsletter, please go to our website, rkequity.com, and register your email so you can make sure that you get that in a timely manner. We just published the monthly scoreboard, which on Sunday, we called kind of Sunday, Bloody Sunday under a blood red sky. It was all red in January. We're having a bit of a recovery day today, bit of a relief rally. I don't know what, but it was after a very negative day yesterday. So we're in volatile times in the lithium space, and it's been painful. Rodney and I joked a little bit a couple of years ago. I said, talked into this camera here and said, there's the ability in lithium space to make life transformational wealth. That also could mean on the downside. So Rodney joked in our first interview 5 years ago that a way to make a small fortune is to start with a large one and then invest in lithium shares. So that has been a dynamic here, but we've been here before multiple times, multiple cycles. Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video. Sam, why don't you give your background a bit? We spoke yesterday, really for the first time. I saw your note. I rang you up. Don't know you very long, but you just joined, I understand, not too long ago at Wilson's after a long career, at more familiar brand names, in both lithium and outside of lithium. So tell us a little bit about yourself, a little bit about Wilson's, and then a little bit, about your note. And then Rodney and I will ask you some questions.
Sure. Yeah, absolutely. Thanks, guys. Look, I've been around as a metals and mining equity research analyst for about 20 years. As you say, more recently at Wilson's Advisory here in Brisbane, in Australia. But the majority of my career, I'm originally from Brisbane, but the majority of my career I actually spent in London. So I worked in various different mining research teams there, heading up teams at Credit Suisse. So I headed up the European mining research there, Credit Suisse, Morgan Stanley, Macquarie Bank. I was on the buy side. I ran a global natural resources fund for Schroders for a few years. Immediately prior to this role, I was head of UK mining research for Canaccord Genuity. Obviously, most people in this space know I'm pretty active in the lithium sector. Recently, after a long time, and prior to all that sort of experience in the finance sector, I was originally a mining engineer working here in Queensland, Australia. So very much mining focused. That's sort of taken me to all sorts of operations around the world in all different commodities. And clearly, the last sort of 5 to 7 years, it's increasingly meant spending a lot more time on lithium markets, which is where I focus a lot these days. Wilson's Advisory, we're a small mid-cap investment bank, and private wealth management firm, Australia focused. My commencement here and a few other hires in the business is part of our efforts to really broaden out our presence in the natural resources space. And obviously lithium is forming a key part of that. as we go forward. And look, I think I initiated on the sector in the middle of last year, and this update that you've referred to that we'll talk a bit more about today is part of a sort of big update, given the pricing falls we've seen last year. And I think it's worth pointing out, you talked about volatility in the lithium space just a moment ago, that if you look at, and I saw this on LinkedIn actually recently, if you look at a basket of commodities, whether across energy and industrial commodities, over the past 10 years, in 6 of those years, lithium has either been the best performer or the worst performer. So, that tells you something about this space. I think you need a strong stomach, but I think the rewards are there for those that can look through that.
We call it volatility, the speed of volatility. So you think that, it's not a lost cause. You can still make money in lithium.
Absolutely. I mean, look, and the thing is, it's, while obviously lithium as a sector and an industry has been around for a very long time, I think it's pretty well accepted that we're going through a huge structural change in the nature of the industry. It's growing, at a breakneck speed. And, in any commodity market that's growing so swiftly, both on the supply and the demand side, there's going to be mismatches through that journey between supply and demand. And we're seeing evidence of that, over the course of the last 6-12 months in particular. And I think that one thing that perhaps gets overlooked, that we've spoken a little bit about in the notes, and what I think arguably a lot of bulls, myself included, probably underestimated to some degree, is the extent to which, we had seen stocking or restocking through the supply chain over the course of, from say 2020 to 2020, end of 2022, really, when prices peaked, and the extent of the stocks that were there, and the impact that the destocking has had over the past 12 months in particular. And I think, that stands as something separate to just supply demand, because I think, again, looking at my experience in other commodity markets, when you've got markets that are close to balance, and sure, we're looking for big structural deficits in lithium longer term, but arguably in the near term, you've got something close to a balanced market. When you've got those sorts of conditions, it is actually the destocking and the restocking cycles that are really the governing factor behind shorter term price moves. And we've seen that now. And indeed, if we think that it can't go on forever, and we do get an end to destocking throughout the supply chain, then 100%, as we've seen on the downside, the prices can recover very quickly on the upside as well.
Okay. So the title of your note is Lithium Sector in Incentive to Buy, right? So the crux of the argument here is pricing is not currently at incentive pricing. So in order for new projects to kind of get online. So could you just, I guess, explain how you arrived at that? And, you said it's based on, it's proprietary incentive price curve. You've looked at 40, undeveloped projects, or, in the, I think, spodumene market, and the carbonate, focused projects. So could you just explain to us your methodology and what you arrived at? And you have a base case here, and then you have a early recovery case, which I tweeted about yesterday, thinking that price could be back to 2000 as early as 12 months from now. We'd all, as bulls and optimists, would love to hope that that's going to be the case. So, but let's kind of get into like your base case and that early recovery case, and just how you built this up.
Yeah, absolutely. So, look, I think across most commodity markets and commodity analysis teams, typically long-term pricing and long-term equilibrium, the sort of methodology that most of the market uses is to think about incentive level pricing. So, you look at what you think the long-term CapEx and the long-term OpEx of building capacity in a sector is, and you say, okay, if we sort of have a minimum hurdle rate of return, what does the price need to be? And effectively, we've taken that concept in lithium, which again, I think you'll find that most of the investment banks out there that put research out on lithium probably use incentive level pricing to get their long-term price forecasts. But obviously, just picking one number out of the air, or even an educated guess, there's potential for that to be incorrect. So we've tried to use the information that we have to actually look at how sensitive different projects, or the all growth projects, might be to what the lithium price is long term, and what price would incentivize different projects. So as you point out, we've gone and looked at about 43 actually projects across spodumene and in the carbonates or the chemical space as well. And the criteria for the projects that we've looked at are typically there has to be some form of economic study already done. So to give us some idea of CapEx to develop the project, some idea of what the operating costs might be. So we don't have every single project that might ever come on board, that they may have, just declared a resource, or just starting to have some positive drill results. This is projects for which we have some idea of how the economics might look. And then we've taken each of those projects and built a separate independent cash flow model on each of those. So throwing in project CapEx to build it, the operating C1 costs, royalties, sustaining CapEx, and then we backed out what the lithium price, or spodumene in case of those projects, or carbonate in the case of those projects, what the price needs to be to actually justify a 15% internal rate of return on that initial CapEx spent. And the reason why we've used 15% is, again, traditionally across most commodity markets, sort of mainstream established commodities, that's been, a traditional hurdle rate that, say, the big miners like BHP Billiton or Rio Tinto have often used as their hurdle rates. And we backed out a lithium price as to what each project needs to get to that price, to get to that hurdle rate, excuse me. So that's given us a curve. I'll talk to that 15% in a moment, whether that's actually an appropriate number. But just to start off with, what the curve has shown is that we've talked specifically about our spodumene curve. There's about 20 odd projects just on that curve. Over 50% of those projects at current spot prices don't make a 15% IRR. Now, what that tells me is, if we're looking forward to a market that we'd all agree, hopefully, is in structural deficit in years to come, as EV demand ramps up and so forth, the market is going to need probably all of those projects to actually be developed, to have any hope of a market being supplied or close to supply. And at this point, if we're saying, well, half of those projects aren't going to get financed or don't make sense to make an investment decision, then that's a problem. And prices need to move higher to ensure that we do incentivize the development of those projects. If you go right up the top of that curve and look at around the 90th percentile of that curve, then you're getting long-term spodumene prices in the order of $1,500 to $1,600 a tonne. And that's sort of what you need to get to around 15% IRR for the top end of the curve. And just coming back to that 15%, I mentioned the genesis for that, but I think, I posted this on LinkedIn yesterday as well. There's a strong argument to say that 15% required return isn't nearly enough. In a commodity or a market such as lithium, where we've spoken already in this session about the volatility that we've seen, most financiers are going to want probably more than 15%, significantly more, 20, 25%. Additionally, our analysis doesn't include the cost of financing. We're not talking about BHP Billiton and huge internal cash flows. A lot of the projects being developed are, companies that don't have any alternative sources of cash and need to fund these things elsewhere. There's a cost to doing that. So it's financing costs, corporate overhead cost. So, in our analysis base case, we've gone and said prices need to go up because there's a significant amount of spodumene capacity, in this case I'm talking about, which isn't economic to develop. But perhaps if we apply some different assumptions, which are arguably very realistic, then that 50% of potential capacity that doesn't make sense perhaps becomes 75, 80, perhaps all of the potential capacity that might come online. So look, we think that we've been very gentle in how we've gone about our assumptions, and we're still getting an outcome that suggests the prices need to be significantly higher, perhaps even with more realistic assumptions, or that it's going to make an even stronger case.
So I guess, Sam, the dilemma or the debate that's been going around the industry, I guess, is there alternative supply that can replace spodumene? If you're going to go straight to, integrated or lepidolite or those kind of things, I guess that's really, for me, been the central part of the argument is, the suggestion that somehow a very low-grade lepidolite with high impurities can now operate on a, cost curve that's lower than the numbers that you're mentioning and than we look at. And I guess the debate is going to come down to not only can you maintain operations at $11,000, $12,000, $13,000 a ton, but you could, some argue grow. And we're struggling with that concept. Where do you stand, in that?
Yeah, if you look at the numbers that we've, the projects that we've put together. So on the carbonate curve, we've got a total of about 1.3 to 1.4 million LCE of undeveloped capacity that we've analysed, and that's inclusive of the spodumene capacity that I mentioned. We obviously have a separate curve for as well. So that's effectively a doubling of today's market already. What we don't have on that curve is some of those Chinese lepidolites. There's a few reasons for that. One is the reliability of information and actually being able to actually generate those cash flow models that we need for each project. Secondly, you could argue that if you're a believer that they are at the top end of the cost curve, that there's some sort of subsidy, I guess, program, if you like. It's probably formalizing a bit much in China to keep some of those operations running. So therefore, they probably wouldn't be particularly useful additions to analysis such as this. And really, I think the final point on that is why they're not included is, and I guess this is a bit of an unknown, how much capacity is actually there when we're talking about 1.3 million LCEs of capacity we've looked at elsewhere. Is the addition of another few 100,000 LCEs of lepidolite actually going to change the conclusion of what we're talking about here? We're talking about significant deficits as you look out, whether you look at benchmark minerals numbers or fast markets numbers or whoever's numbers you look at on a supply-demand basis. The deficits are huge. We're talking about hundreds of thousands, if not over the millions of LCEs. So, we think we've captured the lion's share of that potential new supply for the remainder of this decade. And whether we're looking across the carbonate curve or indeed the spodumene curve, there's still a case that we need all of that. So I don't think we're at the point yet where necessarily we're talking about, say, spodumene being completely replaced. If you look at a comparison I mentioned between the two curves of data we have at the moment, I mentioned around 50% of potential new spodumene capacity shouldn't be built. On the carbonate curve, which also includes spodumene with an allowance for conversion cost, the number is a little bit different. It's around 15-20% of potential carbonate capacity shouldn't be built. So, what that perhaps tells us is that there has been probably a little bit of the current spodumene price is probably overly discounted on a relative basis versus where carbonates come back to. And perhaps we need to see a little bit of a reconnection in there. And I think on a spot basis, spodumene's around 5% of the carbonate price at this point, it's obviously averaged closer to 10% over the course of the last 10 years or so. So perhaps we've seen a bit of an overcorrection in that, and some of the near-term production cuts and rationing announcements that we've seen, may be the catalyst for that to sort of, I guess, recorrect.
And Sam, just you've got the curve there. So I guess one of the other things that caught us off guard is everyone feels 5 to 10 years to build the mine and so on. But the truth is, if the price is high enough, you can get DSO and other things up in a matter of months in some, jurisdictions. So that kind of threw us out. But, that's what $80 a kilo gets you. You open Pandora's box. But I suppose my question is, how should investors look at it? Is there a risk that we now have seen a huge pivot out of some other commodities into lithium because that's what was paying, that's where you could raise money, that's where you could go and search? Are we, is there a danger of material discoveries being made that aren't in that chart, and, where funding, ramp up, etc., depending on who does the discovery, could, the timelines could change and costs? Is there, I guess it's just a question, is there a risk? How do you look at that?
Yeah, look, I think that's a really good question. I think, again, and I'm sort of drawing on experience from other commodities as well, where you've had this extreme price reaction, and then you obviously get, a desire of people on the supply side to try and pile in to take advantage of that. The question is, how sustainable is some of that? You mentioned DSO, for example. I mean, it was sort of all the rage 12 months ago to say, well, we're going to have some early DSO before we get the plant up and running, and whatever operation you're talking about, and it's going to give us some early cash flow. And that seemed like a fantastic plan when, as you say, the prices were at 80,000 a ton or 8,000 a ton for spodumene. That made sense, but obviously we saw how swiftly that material, just wasn't feasible anymore. So perhaps you could argue that, you do get some capping of peaks in pricing, but I think that this is part and parcel of a market maturing, is that, you're not going to sell DSO when there's actually, good quality spodumene that can be easily processed into a 6% concentrate available. And that takes money to process. So I think that, yes, there is, some potential for quick solutions to, an intense and acute supply deficit. But, this is a high capex industry. You're gonna have to need time and investment to actually have sustainable, ongoing supply. And again, as the industry matures, one would think that the precursor manufacturers and the OEMs themselves, that are consumers here, they're going to want to see consistency and reliability of supply. And to do that, you're going to need to see proper planning and proper investment in high quality operations that can do that on a regular basis. We look at, again, taking some parallels. We look at the iron ore industry over the course of the last 20 odd years. There have been some fantastic price spikes at different times, and when we saw that, there was very low grade, poor material being sold to steel mills in places like China, less so to places like Japan. But as the steel industry matured in China, and it was already fairly mature in Japan, there became a bias for quality. So, and it was important that, that you have sustainable, reliable, well-operated suppliers. And I think that, the lithium industry, certainly if we're talking about upstream spodumene, that will progress in that manner as well.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com. Sam, do you have any experience in the aluminum industry?
Yeah, a little.
Because like I very much want to believe in this iron ore analogy, and we have promoted it quite a bit. Life is good, LIFE. But the bauxite to alumina to aluminum, right? If I look at Alcoa, a 130-year-old company, it has like a 9 billion or 6 billion or something like that market cap. Why should Albemarle, be a 30, 50 billion market cap, like a Freeport is, like, why isn't, like aluminum has Russia, over the years and China, but like just China just like overbuilt, and they've overbuilt like a lot in a lot of industries, copper, solar panels, we keep pointing to iron ore as like a better example or the hoped for, good example, but there are many more examples, where it's worked in the wrong direction. Right.
Yeah.
And aluminum, goes into military aircraft, and like aluminum is not necessarily so commoditized. Like it is a specialty alloy, just like a specialty chemical that's going into batteries. So why isn't, the future of lithium destined to be, the loser industry of aluminum rather
Yeah.
than the bullish industry of iron ore?
I think that's a great question, and I don't have a definitive answer, but I've got a few thoughts. And it's something I've spoken a lot to investors about, is that, as you're pointing out, at one end of the spectrum, you've got the iron ore industry. But then at the other end of the spectrum, and aluminium is the perfect example, because bauxite mining is very similar to iron ore mining. It's not actually that dissimilar a product. And in iron ore, the market has evolved such that there is a material and very established sort of third-party merchant conversion industry known as the steel industry, whereas in bauxite, the bauxite industry, there isn't really an active third party. There's a little bit of trading there, but effectively you've got that integrated capacity. So anyone who has an alumina refinery obviously typically owns bauxite capacity as well, and that's fully integrated through the supply chain. Now, why the two differences? It's a very difficult one to say. I suspect that with aluminium, most of your strategic advantage is in having, you've got, for aluminium, the power and electricity cost is a huge cost in the overall cost of producing a ton of aluminium. And so the actual benefit or the rent can be extracted in that whole value chain by the company that has the best power deal at the end, and then you backwardly integrate. In the case of iron ore, you don't have that same, you have much more cost base producing a ton of steel in actually the cost of the iron ore, of the raw materials. And bauxite is a tiny portion of the cost of aluminium. So it all comes down to how this industry evolves. Basically, I think that where the economic rent is extracted, is it in the extraction of the raw material, or is there some differentiated factor in the downstream processing that actually makes the difference? And how the lithium industry ends up, there's going to be lots of people with different opinions. I think it's a really difficult one to put a finger on right now, because, again, as I mentioned at the top of the call, there's an industry that's still maturing and evolving, and supply chains evolving, and how it's going to play out, I think, is very difficult to tell. And that's why, for example, Livent and Allchem, one of the rationales for their deal was to try and have a foot in all camps effectively, because I don't think anyone really knows exactly how that value chain is gonna end up. But I think that's the key as to whether we end up like aluminium or iron ore. So sorry, I don't have a proper answer for you there on that one.
No, that was a very, no, I don't think anyone does, but everyone's making this iron ore analogy, and I'm just trying to, as an active investor, you always have to kind of like test your thesis, based on, new information. And we're hearing like Rio Tinto is interested in lithium. They're very big in aluminum in Quebec, because Quebec has low cost, cheap, clean electricity. So isn't cheap electricity relevant in the steel industry? Is it relevant in the lithium industry? And if Quebec, Alcoa and Rio, have, I don't know, there are 11, 12 alumina and aluminum plants, in Quebec. And if we all of a sudden have a bunch of spodumene mines and hydroxide and possibly carbonate plants in Quebec, again, it goes back to, those businesses aren't very profitable. Like Rio Tinto makes money from iron ore. They don't make money from aluminum.
Yeah.
Right.
Yeah.
So where do we go on this? So there's no answer here. I'm just raising the question, and I was just curious about it. And to Rodney's point, again, you're suggesting we're going to have a structural deficit. You look at benchmarks numbers, in the future, it just shows structural deficit. But 5 years ago, they were forecasting a structural deficit now, and actually the gigawatt hours deployed are much higher than they had forecast. And they were saying mines will never catch up, right? But
Yeah.
mines have caught up and like have overtaken. So like all through COVID, China built a ton of conversion capacity. And then when the prices rose, and Rodney says like, look, structural deficit depends on the price, right? Like, so if you have all the conversion capacity available in China, then a lot of supply will kind of come on stream. So, and none of us that kind of like forecasted that. So, and Rodney was kind of making the point, how many mines are there in Africa that are maybe not in the 40 that you analyzed, right? That could come on stream a lot faster. And also if it's like, somewhat subsidized. There's also this question of, qualification, right? They're, oh, it was only Gangfeng, it was only Tangxi, it was only Albemarle and Livent, a few years ago that was qualified with tier 1 battery manufacturers, right? But now like Sichuan Yahua, I think, is qualified. There was just an announcement, Pilbara with Chengxin. I don't know if they're qualified with actually they said in their customer mix, it was BYD, it was SK Innovation, it was others. There's also this movement to more LFP, which is, and carbonate, is kind of like less stringent. So this gets to, I guess, the lithium is like really hard to make, and it's a specialty chemical, and therefore only a few players can make it, and therefore there should be a premium for that. But it seems like it's becoming more commoditized, and more Chinese. You're not hearing about qualification, right? Like it just, all these converters were built during the pandemic, and they're taking crap DSO and other crappy product, and they're going into all this battery demand. They may not be going into Tesla. Like I don't know. We're hearing that have been a bunch of battery fires in some 2-wheelers. So this quality that you talked about, that over time the steel industry required more quality. Maybe could you assess this kind of question? And then after that, let's go into your stock picks.
Yeah, sure. I mean, look, absolutely. I think that's if I use that iron ore example, then arguably you will need that quality to evolve, without question. I think that to step back to, I think, one of your first points around how much capacity might be coming out of places like Africa that's not in our curve. Yeah, look, that's a risk. I mean, as I say, we sort of had to use the criteria of what who's got an economic study out. We tried to look at who potentially else there is, and yet again, I'd sort of make similar points to what I made earlier when Ronnie asked about lepidolites. Is capacity from there. The stuff that's not on the curve, I don't think there's enough capacity to change the conclusion of the curve, if that makes sense. Sure, the exact numbers themselves might move around a little bit, but I don't think there's enough there at this point to do that. As I say, I think we've got the lion's share, and the thematic is still valid. No matter where the source is coming from.
Okay, great. So we have you have 5 companies under coverage. You labeled Atlantic as your top pick and actionable now. And then you had, questions, around Liontown, Lithium, and Core. And then you had long-term prospect being Ioneer. So let's focus on Atlantic first, and then kind of Lithium as well, just, on the Africa theme.
Yeah.
But you talk about quality. Atlantic's a client of ours, so, we're biased, do your own research. But they clearly have a quality ore, DMS only, but why is it, I guess, actionable now?
Yep.
And a question I have is like, why they're underbid, right? From Assor, and you got all this bid activity in Western Australia, and the stocks went up, pretty close to the bid price, and that didn't happen, in Atlantic's case. So why, what's
Yeah.
the argument?
Look, I mean, you've obviously mentioned they're a client of yours. I'll put hands up here and say, I've been a fan of Atlantic for a number of years. I covered them in my previous role in the UK, obviously UK listed as well, and I've continued that coverage in Australia. And I think that my own observation of the company, both exchanges, certainly true a few years ago, but it's still the case, is that it's sort of underappreciated and underknown, and arguably at this point, they still don't quite have the critical mass of institutional investor ownership. So it's still a very strong retail presence. I think there's reasons for that. Not least of all things like liquidity in each of those markets. It's a bit of a chicken and egg situation. Atlantic listed on the ASX, not even 18 months ago, and that was just before lithium prices started to fall. And so you have that, plus perhaps in the Aussie market at least, a lot of Aussie investors have a preference for what's familiar to them, which is Western Australia, and Ghana seems a long way away. There's perhaps a little bit of behavioural finance here as to why Atlantic probably hasn't done as well as what I certainly would like to think they should, without question. So obviously you had the Assor bid, and the price spiked, but it was only temporary and it didn't stay around there. I just don't think that the name, for despite my own best efforts and the company's best efforts, I don't think the benefits and the virtues of this project and this business are truly understood by the broader investment community just yet. And in that, it presents an opportunity. And you talk about how I've labelled it actionable now. Yeah, and that would be one of the reasons why, is because it's still not quite, people don't quite understand, I think, what it is and the opportunity there. I think that the work that the company have done over the past 12 months in particular in de-risking the project, in working with the Ghanaians, to get the MIF, the Sovereign Wealth Fund investment, to get the mining license over the line, I think has been outstanding. I think, obviously the DFS itself was delivered last year. There's a lot of work gone into de-risking that. Unfortunately for Atlantic, it's all come against the backdrop of the lithium price falls we saw over the course of 2023. So that means that a lot of investors stepped away or lost interest in the sector, because I think that if Atlantic had the news flow that they had in 2023, that had happened in 2022, I think the share price would be a real sort of a level up from where it is now. So, but that's okay. As I say, that's why it's actionable now. This opportunity, the project is progressing well. I think that just this week, the company put out some great drill hole results. On their step out extensional drilling. They had an 83 meters, I think it was, at about 1%, 47-meter hit. We did some work in our research, and we haven't spoken about this report, but we did a report late last year where we went and analysed, thousands upon thousands of drill holes from West Australian lithium sector, and the conclusion in simple terms was that if you're getting plus 50-meter intercepts at an acceptable grade, for spodumene exploration, that's a really good leading indicator that you're going to have a plus 50 million ton resource. But once all the drilling's all said and done, very high level sort of rule of thumb, but nonetheless, you've got Ioneer sitting at 35 million tons at the moment, and now they're starting to get these very long continuous hits. So I think that the likelihood that this ends up north of 50 million tons is very, very strong. So you've got de-risking your project progressing well. You've still got exploration upside. You've got the fact that that at this point they've still got 50% of the offtake uncommitted, which where they are in the world, given the fact that North America is a demand center, Europe is a demand center, clearly lagged China. Having high quality spodumene, not necessarily on their doorstep, certainly a lot closer than Western Australia. I think that it's highly likely that someone will jump on that. Spoke a lot in my research about the fact that Piedmonts are in there with 50% of the offtake and an option to make sure they get to 50% of the asset. But as I understand it, there's no preemptive rights that Piedmont holds. If there is a third-party bid for Atlantic Lithium, that means that any bid for Atlantic Lithium would be an open contest, which is rare, I think, in this sector. And then probably a lot of people aren't aware of that. They would think that Piedmont would effectively have that clause tied up, which they don't. So, look, I think that from just an organic project development perspective, but also from a potential acquisition perspective, Atlantic Lithium is a fantastic option. I probably rambled on about that for too long, but I'm a big fan.
No, it's fine. No, you said the story is not well understood, and here you have an opportunity to help our viewers, understand it. I want to just challenge you a little bit. You kind of mentioned that it's mostly a retail held stock. It's not like an institutional held stock. I mean, do you think that, in my experience, retail investors can bid stocks up to much higher valuations that institutions can? Like if you look at Sayona, Lake, AVZ back in the day, this didn't have very much like institutional ownership. It was retail excitement that like kind of drove the stock up. So in your experience, is that like institution versus retail dichotomy determining value correct?
I think that you make a really good point. Yes, absolutely. Retail, strong retail presence on the register can take stocks very, very high. I guess depending on your investment philosophy and investment approach, the issue is that they typically tend to be short-lived because retail by its nature comes in and out. They pile in volume, and you can take values very, very high, but often they'll also exit with the same speed. And so, if we're looking at balance and building a company that's reflective of its value longer term, I think having a substantial institutional presence on the register just gives you that ballast, if you like. Now, to be fair, Atlantic have got some big strategic holders, so perhaps that's in lieu of institutions. They've got Azure, they've got Piedmont, or slightly less Piedmont recently on the register. But the issue is that that's not traded, and so I've mentioned the liquidity. I think is a barrier for some institutions to get involved. But look, it's not a deal breaker by any sense. if the stock does well, the retail community can take it higher and higher. But it perhaps can help reduce a bit of volatility if you've got a few institutions on the register, typically.
In my experience, I mean, this has a big retail following, out of London, but they moved to Australia because AIM is lame, right? Is what we say all the time. And Australia understands hard rock, but maybe you're right, the timing wasn't great. But maybe they don't love Africa and in Australia. But if you think that this could be a 50 million ton, this is a very easily understandable, project. But you also do have AVZ and Leo Lithium in trading halt, as Africa stories.
Yeah.
Uh, Ghana is a different political risk. Maybe you could kind of talk about that, talk about Leo Lithium, but also from a fundamental value point of view, why do you think Atlantic is cheap?
Yeah, absolutely. So you're absolutely right. I mean, as I said, I obviously spent a lot of time, my career in London and broking in London on, say, Atlantic. There's much more an appreciation amongst the investment community, whether it be retail or institution, of Africa, and perhaps that's more so than in Australia. And I think that's not to be negative towards Australian-based investors at all. It's more that they've been, we as Australians have been very fortunate in that there hasn't been a need to go to Africa. Whereas if you're based in some of these big centres in Europe, there's not many mines in and around London, Greater London area. So you have by necessity to obviously go a bit further afield. Whereas Australians have been very lucky to have some of the most fantastic industry in their backyard. So, I do spend quite a bit of time trying to explain to investors from all different walks of life, retail and institutional, that Ghana is not Mali. The Ghanaian track record, for example, in the gold mining sector is outstanding. And I think that I mentioned before the relations and the progress that Atlantic have made in the last 12 months. And I think the Ghanaians have shown best practice for, how to work with a new developer in a new industry, obviously new mining code for green metals. And I think the way that they've instituted that and publicized it and consulted has been absolutely first class. And that stands in stark contrast to what we're seeing in Mali at the moment. And look, just to so on that basis, I'll quickly touch on fundamental value in Atlantic before I move on to Mali and Leo. On that basis, we're comfortable that when I go and calculate an NPV or a discounted cash flow for Awoya and for Atlantic more broadly, that matches what my price target is for the stock. We're up at over $1 a share. Shares are currently less than 40 cents. And I'm happy to stick by that with conviction that the stock should trade to our valuation. Whereas with a Leo, so it's not trading at the moment with the issues in Mali. We have a fundamental valuation just looking at Goulamina, quality of that asset, on the basis of our price view. That we have a fundamental NPV of about $2 a share for Leo Lithium, but I've got the stock at a 45-cent target on a market weight recommendation, which is effectively like a hold, purely because I struggle now with any conviction to see a pathway to how the market's going to recognise and be willing to pay for that full freight or full value for business in Mali, given, just in the last week, and look, that move down to a hold for Leo Lithium is only recent. That was part of this report that we're talking about today. I previously had it on a buy because of that fundamental upside to valuation, but just in the last week, and I'm not sure how well publicized it's been, but the political situation in Mali has changed significantly just in the past week for me, in that previously, 2 years ago, you had ECOWAS, which is like the African, West African EU, the sort of trading and political union, put sanctions on Mali post the last military coup and made them commit to a timeline for democratic elections. That was agreed as being this month, February 2024, and that was the expectation. Late last year, you had news flow out of Mali that might slip a little bit, but now, just in the last 10 days, you've had news flow that Mali has actually decided to exit ECOWAS, and there is absolutely no timeline to democratic elections. So for me, the nation was moving in a better direction geopolitically. Now they're moving, I think, in the opposite direction, and it's a concern. So, Leo is a really tough one because, by all reports, the actual construction of Goulamina has been progressing relatively unhindered. It should be a great asset, obviously, with the big trucking distance to port. But how that value flows through into a stock like Leo, an ASX listed stock with a minority stake in the asset is a bit more questionable now.
Okay, that's very helpful. It's kind of a moot point to kind of have a buy on a stock that's in trading halt. So not too risky of you to say to hold.
Yeah, that's right. I think everyone will be following my recommendation.
But the bigger question, from our perspective, we don't care so much about Leo Lithium. Like we're trying to actually figure out, like, from a structural deficit, what kind of supply component stream. Rodney keeps, very detailed models. I think he was modeling something like 150 or 120,000 tons of spodumene to come from Goulamina this year, right? And that's supposed to ramp up to 500,000, I think, next year. Gangfeng, which has had problems in Mexico with Bacanora, I think they're getting an impairment there. You're kind of saying, like, the operations are fine, all this like political problems in Mali, it's, but we're hearing, I don't know, some terrorists, going after some gold that's trying to be shipped out of Mali. Like, is there a risk that this project gets slowed down and then those who have Goulamina in their models, because our thesis, a lot of this story here is what kind of supply might not come on stream, which might impact, pricing in the short term. So what's your assessment on discontinuing?
No, I understand what you're saying there, because it's obviously, theoretically, as you point out, it's going to be a big part of a lot of people's supply models in the course of the next 12, 24 months. Like, as I say, look, I've got a few people I know that work in and around the industry, and from what I'm hearing, as I say, from an operational perspective or a project construction perspective, things have been progressing sort of largely on track. Look, is there no risk? Of course not. I mean, there's obviously security risks in Mali. I mean, Goulamina is located in a part of the country that's probably less susceptible to those issues. It's more up in the north, where I think most of the security concerns will be. But yes, absolutely, it's a risk. Although on the flip side, while the Malians, from what I understand, have clearly been squeezing, Leo and trying to extract, all the sort of benefits they can out of these guys, through, and we had Leo announce recently there'll probably be some sort of financial settlement once they conclude their discussions with the government. I think at the end of the day, Mali is a very poor nation, and I think they need and want this operation to get up and running and start to actually generate income for the country. Now, my concern from a Leo perspective is, what will their ownership stake be, and what part will they play? But I think that the operation itself, with Gangfeng in there, obviously as a very hefty representative of China Inc., as it were, will certainly mean that the operation will likely get up and running. Maybe it's not quite as swift as they initially had hoped, but I would be surprised if the operation, wasn't a priority. It just depends on who extracts the most money out of it, whether it's Leo or Gangfeng or indeed the Malian authorities.
To be honest, I don't care so much on the Leo side because at this point it's a gang. It's a stub of an equity ownership, right? It's hard to buy a stock, that has less than 50% ownership.
Yes.
But there's a big dynamic in the industry of China going to Africa because China can't go to North America, they can't go to Europe, and other places. And you have a number of companies in kind of Zimbabwe, Gangfeng. The cornerstone of Gangfeng's operations is Mount Marion. But with Goulamina getting to 500,000, the dynamic there will change, and I don't know how that might impact the relationship with Minres, et cetera. But if there's some sort of a glitch because of political problems, in the country, but China's, they're happy to work in the DRC, they're happy to work in other places. I mean, Ganfeng's a very professional, awesome company, and they've had to venture, quite far afield. I just wonder. But you're saying the Mali government needs money.
That's what I'm hearing at this point.
Yeah.
The construction.
I haven't visited Mali recently for obvious reasons. So I don't have
that's all good. Let's go to the other one with questions. Is Liontown going to be producing spodumene in the middle of this year?
I'm saying yes. I believe that this again. I was at Kathleen Valley in the second half of last year. For what it's worth, I was pretty impressed with the progress they're making. The company announcements have said that the project is 72% complete. Obviously, I'm sure that can vary depending on how they measure that. But nonetheless, the company remains committed to the fact that they should finish construction by the middle of the year. The key question mark here, and as you point out, the question marks, it's sort of categorized under that in our research, is the funding gap. We obviously had big headlines a couple of weeks ago that after Wood Mackenzie changed their lithium price deck, that it spooked the bank, the lending syndicate that gave commitment to Liontown for a $760 million Aussie facility. And so Liontown have said that they've got cash in the bank, sort of 500 million on Aussie, to finish construction. The issue, though, of course, is particularly in a lower lithium price environment, is they're going to need another 150 million odd of working capital to ramp that operation up in the second half of this calendar year. We would think they would like to maintain a cash balance of at least 150 million as well. So we're saying they're around 300 to 350 million dollars Aussie short in terms of funding to actually get this project to positive cash flow, not just through the end of construction. So at the moment, again, all reports are the construction is progressing well. The issue over the next couple of months is what's the funding solution going to be? Is it going to be the same banking syndicate with a lower amount of funding? Is there going to be some sort of offtake funding? Is Gina Reinhardt and Hancock Prospecting going to stump up some sort of form of funding as well? And so at the moment, why I've got Liontown as with question marks is not really questioning the asset or necessarily its timeline at this point, just because you've got this big question mark on how they're going to fill that funding gap. I think once that's done and the market has reacted to however dilutionary or otherwise or costly that financing is, then what you have is an operation that is pretty close to producing, and arguably that would be the time to have another look at it.
Right. I think in your note here you have what incentive price is necessary for. Here we have Leo Lithium. You're saying Atlantic Lithium. The break-even price is $629. The incentive price $820. Liontown break-even price $743, and the incentive price $1,030. Right. So the price is not at the incentive price today, and they have a funding gap. This is one of those projects that shouldn't get funded, and they shouldn't be in production in the middle of the year.
Yeah, I mean, look, that's a very good point. I mean, at the moment, So what that tells us is, the lending syndicate obviously have to believe that the prices are going to go above $1,000 a ton.
No, but they're using Woodmax, so they had
So they're not going to right
they had a
now.
material adverse change clause or whatever. So the syndicate's not going to suddenly say, oh, let's use benchmark or a blend of fast markets right there. So Gina Reinhardt may come in, but if she comes in, like, is it prudent to rush to come to market with those tons in this market environment, or is it more I mean, they've drawn down on Ford. I don't know when they need to
Yeah, it's
repay
fully
that.
drawn. Fully drawn.
So, I don't think that Ford wants to be a miner. But they could sell their debt. They could do something there. But it seems unlikely that they should. Why rush to try to get into production in the middle of this year, right? And sell into, a market that is not yet healthy, on speculation that it might be, right? Like, no one knows. We don't know. The prudent thing is to wait.
You make a good point, Howard, about, I think, they've obviously, Liontown have talked about pulling back on CapEx for the sort of phase 2 development, pulling the plant up to, I think it's 4 million tons per annum, and staying at sort of phase 1. So, probably pushing that out. I guess the difficult part for, companies when you're making this level of capital investment is the more you delay, the more it costs you. You just another month delay in before you get to positive cash flow is another month of working capital that you're burning to get there. So as long as I would imagine that they believe they can make cash, so not necessarily the incentive price, but as long as they think they can actually make cash on an operating basis, post the working capital for ramp up, I would be surprised if they voluntarily pushed it materially out.
Okay. Well, Core shut down. What price do you think, so they made that decision, the costly decision to shut down. What price do you think spodumene needs to be for Core to kind of come back? And how long does the price need to kind of be at that price if you were in Core's shoes and said, okay, let's kind of turn it back on?
Yeah, I mean, look, it's I'll give you a number. We've in the research we've said that Core's at Finnis's break even is just shy of $1,100 a ton. But what I'd say is I wouldn't call that a high conviction number on our behalf, because Finnis has only had not much more than 6 months operating history. None of its performance really matched up to the study levels, in the feasibility studies. So, I think they were still trying to get the sort of handle around, or they still are, around the plants. I mean, the plant's been nowhere near study recovery levels. So, we've modeled a sort of a recovery in that operation and them starting back up in the start of calendar year 2025, and have said, they need around that level. But that's us. I'm sort of plugging the gaps with a lot of guesswork at this point in time.
If you look at if operations go offline and come back on, what would you typically think they'd need as a buffer above where they think their costs are in order to make the commitment and the costs and get back in? I mean, I would think that's fairly sizable.
Yeah, absolutely. And look, off the top of my head, I can't recall. We have made a significant allowance for working capital to ramp back up, because that sort of 1,100 number I mentioned as perhaps a break even is when they're back at full capacity, steady state. So yeah, there's obviously going to be they're reasonably well capitalized at the moment. They did some equity raises last year, but absolutely, there's going to need to be a bit more spend to get to recommission a project for sure.
How confident are you in the work that Liontown did compared to Core?
More confident, I suppose. I think, and look, by the previous management team at Core Lithium, by their own admission, they were pursuing very much a speed to market strategy, because their timing was sublime, right? I talked about Atlantic Lithium, perhaps, having a bunch of good announcements in the wrong year. Core did it sort of, a couple of years earlier, and the share price reaction over the course of 2022, 2021, when they were really sort of moving very quickly to get to first cash flow, and when prices were as they were, it sort of didn't really matter if you perhaps didn't have the same depth of due diligence on, how they're going to develop BP33, which is the next ore source at Finniss, for example. But I think in the case of Liontown, it's they haven't adopted that strategy. They're more trying to adopt probably a more robust, longer term, and obviously it's a significantly bigger scale project than Finniss. So my gut feel, at least, is that the study work that's been done is a little bit more robust than we saw it.
Okay, but it's more complex, it's underground. So like, we'll see.
Yeah.
I'm just
We'll
hearing
see.
skepticism from various places that, you don't know.
I've heard the same things.
And when Gina Reinhardt kind of was vulturing around, she was making in her press releases, like, announcements like, Roy Hill, $10 billion. We understand big projects. This is not so easy, right? They're kind of illusions. Okay. So finally, a sleeper, long-term prospect, Ioneer. Like, why do you cover that? Well, like, not that many people cover it. It's a little bit, we like James Callaway. We've known him a while. Other than Ken Brinsden, he's the only CEO of a developer, or he's the executive chairman of a lithium developer that's done it before. They're partnered with Sibanye. They actually have a loan. Lithium Americas and others are trying to get loans. And they're very far advanced, as we understand it, in the permitting process. So I look at, you don't cover Lithium Americas, but Lithium Americas, in America, there's all this talk, like, they have a 600, 700 million market cap. They're going to get a loan, Catalyst, GM comes in, and then they build the project. But Ioneer is like, whatever, 150 million market cap, like, meaningfully lower. They already have the loan, right? They just got to get permitted. So, like, what's more likely, like, Ioneer getting, or from a risk reward perspective, there's permitting Catalyst, right, versus loan Catalyst, right? And these are often compared, these two projects. And yes, Ioneer has sold 50% of the project to Sibanye, but it looks like GM will own 30%, of Lithium Americas. But there's also the boron, aspect to this. So it's not fully a lithium company, but in this market environment, actually the boron credit might actually be a positive. Like, I'm not invested in Ioneer. We're not, connected to the company, so I'm not conflicted here at all. I'm just like, I'm looking at the scoreboard and thinking about, like, what's cheap, like, where there are potential catalysts. And, it's rare that we have someone who actually covers the stock. and,
Yeah.
and other than Atlantic, it has, like, your most upside after Atlantic, but you're saying it's a long-term prospect. It's not an actionable now name.
Yeah, I mean, look, I think, and you're right. It does sit as a little bit of a little bit outside the box for, with the rest of the coverage, given everything else is spodumene. So I can't really explain that. I think when I was looking around and starting to initiate in the sector, is one that I thought was very interesting. For want of anything else. So, look, I think for Ioneer, it's, and you said a sleeper, and actually my initiation, the title sort of strapline for Ioneer was the sleeping giant, in that potentially you've got this massive resource, you've got all this offtake already agreed, with various different players. So you've got massive resource, offtake in place, funding in place through the 490 million with Sibanye and the 700 million through the DOE, and so you've got all these tick, But as you point out, it's sort of not valued very expensively, certainly, versus some others. So I sort of think it just needs a few catalysts. I mean, clearly, probably lithium price going up would be a helpful one. But I think that from a stock-specific perspective, you've got all those building blocks in place. I think what they need, and look, I know, the guys there have been obviously beavering away in the last couple of years, doing a lot of technical de-risking, on the project, on the processing. Bernard Rose obviously been, as a very strong technical background, has been focusing on that. I think what the market needs, so because it's been stuck in this permitting stasis, and because the last feasibility study update was 2020, I believe, it's sort of been forgotten about by the market. When I initiated on, and I did go around talking about it a little bit, during 2023, that was the sense I got as well. There's a lot of investors were like, oh yeah, those guys, what's going on with them? So I think that it's sort of been a back burner type stock, certainly in the Aussie market. I think that for that sort of value potential to be realized is, I think that through the course of this year, we need to see updated economics, which I know the company are working on. So effectively an updated feasibility study. The old CapEx numbers from 2020 are not worth anything nowadays, for example. So we need to see what's the new CapEx number, how do the new operating costs look, basically, once you take today's assumptions and obviously the de-risking they've done on the technical side. They need that, and obviously they need the announcement of the final BLM permitting, which, as you point out, theoretically should be imminent. So I think that the permitting plus some updated study work. So you really then you sort of go, okay, well, we've got a business now that's got great looking economics. It's got permitting done, it's funded. Now we just got to go and build this. I mean, that's not insignificant risk or process, but that's suddenly you look at it and can go, why is this so cheap? A heavily de-risked, fully funded project. But until such time as we just get over a few of those hurdles and see some of those catalysts come to market, then it'll probably still sit around where it is. But once that does happen, I think it's a very exciting prospect. That's why I've sort of classed it as more of a long-term option.
Got it. Appreciate that. Sam Catalano, very nice to meet you. Glad one of our friends forwarded over your note to me, and we got to know each other. We're committed to providing differentiated and consistent content here as we navigate the lithium bear or ride the volatility. And if I were to, I don't know how much you've watched Rockstock, but we're very much focused on themes to popular culture and music. If there was a particular song or band that you would want to most exemplify Sam Catalano and this podcast, what song would that be?
Oh, you really put me on the spot there. Yeah, I mean, look, I'm a big fan of Pearl Jam, so pick whatever you like out of there.
Pearl Jam. Okay. Even Flow, Jeremy.
Yeah.
We'll come up with something. I'll think of something. Okay, Sam.
Yeah.
Thanks very much for your pearls of wisdom.
No problem. All right. Thanks, guys.
Take care.